I welcome all of you on behalf of our study circle on today's webinar on this subject topic amendment applicable to AY 22-23 and 21-22. ते पण ते सेवेज घेणार आहेत सर. Our speaker one and one, our very respected CA Vinay Kawdiya. Sir, welcome you.
Thank you, sir.
Welcome you all members. आपण दरवर्षी प्रत्येक वर्षी आपल्या अॅन्युअल जनरल मीटिंग नंतर आपण इन्कम टॅक्स लेटेस्ट अमेंडमेंट ऍप्लिकेबल इन्कम टॅक्स हे घेत असतो आणि आतापर्यंतची आपली जी प्रथा होती त्याच्यात एनएच दोषी सर घ्यायची नेहमी. आता एनएच दोषी सर मी जे आपल्याला आतापर्यंत मार्गदर्शन त्यांचा आभारच आहे आपण, परंतु त्यांच्या ओल्ड एज मुळे त्यांनी यावेळेला नकार दिला की मला इतक्या वेळ बोलता येणार नाही आणि ऐन वेळी आपण विनय कावड्यांना फोन केला त्यांनी ऍक्सेप्ट केलं, त्याच्याबद्दल ऐन वेळी त्यांनी आपलं हे स्वीकारलं, त्याच्याबद्दल त्यांचे आभार आहे. सर्व मेंबरचं स्वागत आहे आजच्या मीटिंग मध्ये जेवढे आलेत त्यांचं. मी विनय कावड्या सरांना त्यांची ओळख देण्याची गरज नाहीये, ते लोकल आपले प्रॅक्टिस पण करता अपील मध्ये तर ते टॉपलाच आहेत आपल्या जळगावला. मी त्यांचं स्वागत करतो आणि त्यांना विनंती करतो की त्यांनी काही वेळ न हे करता सुरू करावं.
थँक्यू सर. नमस्कार सगळ्यांना. सर्वप्रथम एन.एस. दोशी सरांच्या जागी मला संधी दिली त्याबद्दल मी आभारी आहे संस्थेचा. त्यांची जागा आपण कोणी भरून काढू शकत नाही, पण मी प्रयत्न करेल सगळ्यांचं शंका समाधान करण्याचा. सर्वप्रथम काल जी दुःखद घटना घडली, आपले अध्यक्ष श्री मगन पाटील सरांचे ज्येष्ठ बंधू यांचं काल दुःखद निधन झालं, त्याबद्दल तर भावपूर्ण श्रद्धांजली. आणि विशेष उल्लेख करण्यासारखी गोष्ट म्हणजे आज सकाळी 5:22 त्यांनी ॲडव्होकेट राजेश बुंदे सरांचा बर्थडे विश संबंधी त्यांच्या शिस्तीप्रमाणे मेसेज टाकला आणि त्यातनं आपल्याला सगळ्यांना शिकवण दिली, शो मस्ट गो ऑन. या अशा नाजूक समयी सुद्धा, इतक्या दुःखद प्रसंगी सुद्धा त्यांनी त्यांची कामाची शिस्त सोडलेली नाही. सकाळी 5:30 वाजता त्यांनी रुटीन प्रमाणे त्यांचा आपल्या मेंबरचा वाढदिवस न विसरता त्यांना विश केलेला आहे ग्रुपमध्ये. आणि हे खरंच त्यांच्याकडून शिकण्यासारखं आहे की कुठल्याही प्रसंगी संस्था कशी चालवावी याचं ते आज आपल्याला सगळ्यांना उत्तम परिपाठ घालून देत आहेत. त्याबद्दल त्यांचं मी आभारी आहे. त्यानंतर सुरुवातीला असं ठरलं होतं की आपल्याला फायनान्स ऍक्ट 21 बद्दल बोलायचं आहे, पण नंतर ऐनवेळी मला मेसेज मिळाला की फायनान्स ऍक्ट 20 दॅट इज ऍप्लिकेबल फॉर रिटर्न फायलिंग फॉर EY 21-22 ते सुद्धा कव्हर करा. इफ टाइम परमिट्स आपण ते सुद्धा कव्हर करूच. आय एम युझिंग द प्रेझेंटेशन विच ॲज अ पार्ट ऑफ एडिटोरियल टीम ॲट टॅक्समन. आम्ही एक टीम म्हणून एका टीमने मिळून आम्ही प्रेझेंटेशन बजेट नंतर दरवर्षी तयार करतोच. त्याच मी डायरेक्ट यूज केलेलं आहे कारण ते एकदम सिम्पल, सोबर आणि शॉर्ट आहे, येट कव्हरिंग ऑल द अमेंडमेंट्स. त्यामुळे रादर दॅन प्रिपेरिंग सेपरेट डिटेल्ड PPT, आय एम युझिंग दिस विथ द ड्यू परमिशन ऑफ टॅक्समन. युनियन बजेट, हायलाइट्स ऑफ द फायनान्स बिल 2021. नेक्स्ट स्लाइड. हेड वाईज आपण याला डिस्कस करू. इम्पॉर्टंट अमेंडमेंट्स. सर्वप्रथम इन्कम अंडर द हेड सॅलरीज. There were no much amendments relating to the income under the head salaries. Some of the important amendments are listed on the page. That is exemption for cash allowance received in lieu of leave travel concession. Where an employee receives LTC from his employer for going to vacations in India, there is a deduction available and exemption available under section 10 subsection 5 subject to certain conditions. Those conditions are mentioned in Rule 2B, Rule 2 capital B. Subject to these conditions, the LTC exemption in respect of LTC is available to the employees. Due to COVID-19 pandemic and national lockdown, employees have not been able to avail this benefit for the current block of 2018-2021. And to mitigate this hardship and to provide relief to such employees, the section has proposed to amend to provide the exemption in respect of cash allowance received in lieu of LTC. However, the exemption is allowed with subject to certain conditions which are mentioned in Rule 2 capital B. And one of the main such condition is that the amount so received should be incurred by the assessee or a member of his family during period 12th October 20 to 31st March 21 on goods or services which attract GST rate at the rate of 12% or more. That means this benefit is available subject to condition that the employees should utilize this cash incentive received in lieu of LTC for the prescribed purposes, and it should be expended on the goods or services attracting GST at the rate of 12% or more. And certain other conditions are there in detail are prescribed under Rule 2 capital B. And the expenditure should have been incurred between the block of October to March 21. Next is interest on PF. Till date, we know that it has been proposed that exemption shall not be available for interest income accrued during the previous year on the recognized provident fund in account of the person to the extent it relates to the contribution made by the employees in excess of 2.5 lakhs in a year. In short, interest accrued to the employees on their PF balance in excess of 2,50,000 now has become taxable from AY 22-23, financial year 21-22. Of course, to the extent it relates to the contribution made by the employees in respect of interest accrued on the employees' contribution part, which is in about 2,50,000, in excess of 2,50,000, it shall now be taxable. So till date, entire interest was exempt. Now interest attributable to the employee share in excess of 2,50,000 credited to the provident fund has become taxable. Profits and gains from business profession. So these were two significant amendments under their salary, and one more important amendment relating to tax slab rates was there in Finance Act 2020. Two independent tax regimes were made available by Finance Act 2020, which we'll discuss at the end of the session. Till date, there were no such two different optional slab rates available in India. For the first time, Finance Act 2020 introduced two different tax regimes depending upon the total income and the type of deductions the assessees are availing. One can choose between those two options. We will discuss later on. As far as Finance Act 21 is concerned, there are no changes in slab rates applicable to any head of income. Now we'll come to PGBP, profits and gains of business profession. No MAT on dividend income on foreign company, leave that. Then important is no deduction for employees' contribution if not deposited before the due date. This was very controversial point till date. What was happening till date that as a tax auditor also we were not reporting this as a disallowable under section 43B. The employees' contribution which was paid after the due date prescribed under the relevant statute, but before the due date of filing return of income. That was not a disallowable item. There was much controversy across India among various high courts. Some high courts were in favor of the assessee, some high courts were against the assessee, that yes, due date applicable to return of income is applicable, and even if the employee's contribution is paid by the employer after collecting from the employee on or before filing return of income within the due date under 139(1), then it shall be allowed. And some courts said that no, it should have been deposited on or before the respective due dates prescribed under those relevant acts. Now, Finance Act 21 put the controversy at rest against the assessee in favor of revenue, and they have clarified that under section 36(1)(5)(a) that section 43B is not applicable for determining the due date under this clause. So, for the purpose of section 36(1)(5)(a), due date means the due date prescribed under that act and not the Income Tax Act. And for this purpose, they have clarified that section 43B is not applicable and should not be considered as applicable since inception for determining the due date under this clause, that is clause 36(1)(5)(a). Now, this is a clarificatory amendment, and therefore it is a retrospective amendment, and all controversies now put at rest in favor of revenue, and it is a retrospective, and therefore earlier disputes pending, if any, shall go in favor of revenue. Further, they have clarified that section 44ADA, they have clarified that the section specifies, allows specific professionals to pay the tax on presumptive basis, the professionals prescribed under section 44AA. And there was ambiguity that whether it is applicable to LLP or not. They have clarified only individual HUF or partnership firms not being LLP shall be eligible for this particular presumptive tax benefit under section 44 ADA. So LLPs are not covered under 44 ADA as clarified by Finance Act 21. Then increase in the threshold limit for tax audit to promote digital transaction. We all know 2 years back government increased the tax audit limit to 5 crores subject to condition that 95% or more of the receipts and expenses should be in non-cash mode. Now, to promote the digital transactions, the threshold limit for the tax audit is now proposed to be increased from 5 crores to 10 crores with effect from assessment 21-22 itself. This is very important. Though this is an amendment by Finance Act 21, it has been made applicable immediately from AY 21-22, that is financial year 2021. And if the gross receipts and the gross expenses, 95% and above receipts and expenses are above 95 are in non-cash mode, and the turnover is up to 10 crores, then no tax rate shall be applicable.
तुम्ही याच्यामध्ये प्रॉव्हिडंट फंडाचं सांगितलं ना, सीपीसी ऑडिट रिपोर्ट प्रमाणे डिसॉल्व करून पाठवून देते.
सर सीपीसी सर आता कसं आहे, विषय असा आहे की ही अमेंडमेंट आता आली, बरोबर. याच्यापूर्वी डिस्प्यूट होता.
डिस्प्यूट मध्ये वन साइडेड डिसिजन घेऊन पाठवून द्यायचे ना, डिडक्ट करून डिमांड काढून पाठवून द्यायचे ते.
आणि कन्सिस्टंटली पीपल वेअर फायलिंग होत होता एज फार एज आपलं नाशिक रेंज. पण आता ही जी अमेंडमेंट आली आहे ही क्लेम दॅट विल गो इन फेवर ऑफ रेव्हेन्यू.
ओके.
आता परमिसिबल आहे का नाही हा वेगळा वादाचा मुद्दा आहे. ऑन मेरिट्स जर चर्चा केली तर नाव इट इज इन फेवर ऑफ रेव्हेन्यू. आणि या 143(1) मध्ये स्पेसिफिकली काय इंटरेस्टिंग अमेंडमेंट आले आहे ते सुद्धा आपण पुढे डिस्कस करू, त्याच्यात हा पॉईंट कव्हर होईल. नाउ नो डेप्रिसिएशन शॅल बी अलाउड ऑन गुडविल. दिस इज अ बिग अमेंडमेंट. What was happening earlier, Goodwill, various courts and recently Gujarat High Court in 2 years back clarified that Goodwill is a depreciation is allowable on Goodwill. Ata, now what has happened, they have made amendments to series of sections. Section 43 subsection 6, section 32(1), section 55, section 5050 and section 2 subsection 11. All these sections are amended to make them harmonious and so as to keep the goodwill outside the purview of block of assets and depreciable assets. What they have done, they have amended section 43 subsection 6 to provide a mechanism to exclude goodwill from block of assets. Then they have amended section 32 subsection 1, that is goodwill of business or profession is not an intangible asset for depreciation purposes. They have amended section 55 to clarify about the cost of acquisition of goodwill. They have amended section 5050, manner to determine WDV of block of assets and short-term capital gain if goodwill is a part of block on which depreciation was claimed in past. We all know section 50 is regarding short-term capital gain, deemed short-term capital gain on sale of depreciable assets. Now, if goodwill is forming part of block of assets and that block of asset is sold, then how to handle that goodwill part while calculating the WDV and STCG is now mechanism is provided in section 50, so that goodwill part should be excluded from that. Then they have amended sections to subsection 11 to exclude goodwill from the block of assets. However, one important point to note here is that even after the amendment, still other intangible assets such as know-how, patent, copyrights, trademarks, license, franchise, or any other business commercial rights of similar nature are still eligible intangible assets for depreciation purposes. Only goodwill of a business or profession is excluded from the definition of block of assets and from the definition of depreciable assets. There is a thin line of difference between what is goodwill, what is patent, copyright, trademark, license, franchise, or any other business commercial rights of similar nature. If we can comfortably establish our case that whatever depreciation is charged is not on goodwill but it is on the know-how or patent or any other business or commercial right, then the depreciation shall be allowed. It is specifically excluded. Goodwill of business or profession is specifically excluded. Now, income under the head capital gains. Now, the system of slump sale of business undertaking or unit as a whole for a lump sum consideration, the overall taxability and law was very much settled on this issue. Now they have changed section 50B considerably. What was happening till date, actual lump sum consideration received for the sale of transfer of undertaking or unit of an undertaking was considered as full value of consideration. There was no there was no any deeming fiction or no provision under the act to calculate the full value of consideration. Whatever actual monetary or non-monetary consideration is whatever consideration is received, that was the full value of consideration. And accordingly, section 50C was not applicable to section 50B. The principles of section 50C, that is in case of immovable assets, stamp duty valuation shall be the deemed value of the full value of consideration. This was not applicable till date. Now what they have done, for the first time they have inserted in subsection in 50B subsection 2 the formula to calculate fair market value of the full formula to decide the full value of consideration. And they have clarified that with effect from AY 2022-23, fair market value of the undertaking is to be calculated as per Rule 11 UAE, which was notified on 24th of May 2021. Now, whatever consideration is received for the transfer of undertaking is to be compared with the FMV as to be calculated as prescribed under Rule 11 UAE. What they have done, they have indirectly applied the principle of section 50C to the assets forming part of the undertaking. What was happening earlier, entire undertaking which might be including depreciable assets, non-depreciable assets, movable assets, immovable assets, liabilities, debtors, creditors, etc. and lump sum consideration is say 1 crore, then sale value was 1 crore. And there was formula prescribed to calculate the cost of acquisition of the undertaking. Now, two formulas prescribed are, first is for calculation of FMV of the undertaking, and second is to calculate the cost of acquisition of the undertaking. And how to calculate FMV means actual sale consideration is to be replaced now because of this amendment with fair market value of the undertaking. And it is to be calculated as per formula prescribed under Rule 11 UAE. There are two formula, FMV1 and FMV2, whichever is higher, that will be taken as FMV. Very long formula is there, we will not discuss that, but roughly saying jewelry, artwork are to be valued at open market value on the basis of valuer's report. Immovable properties are to be valued on the basis of stamp duty valuation prescribed by sub-registrar. Then shares and securities to be valued on the basis of fair market value as per Rule 11 UA, which is prescribed for valuation of shares and securities, and so on. So now item by item valuation is to be done, and then FMV of the undertaking shall be decided, and then calculation of capital gain shall be done under section 50B for the purpose of slump sale. Then transfer of capital assets to partners members on dissolution of the firm may be taxable as capital gain. Now section 45 subsection 4 was fairly settled pre-amendment period. As per section 45 subsection 4, any distribution of capital assets by a partnership firm to its partners or dissolution or otherwise of the partnership firm was liable to tax under section 45.4. So basic conditions under 45.4 were pre-amendment, there should be dissolution of the firm and there should be distribution of capital assets among the partners of the firm. If these two conditions are satisfied, section 45.4 was applicable. As a natural corollary, it was not applicable to the situations which is other than dissolution of the firm. It was not applicable for transfer of stock in trade among the partners of the firm, and so on. Now what have the entire system of this taxability of distribution of partnership assets to the partners by the firm is changed, and now they have prescribed 2-3 different sections. Section 45.4 is replaced, section 9 capital B is newly introduced, section 48 subsection 3 is introduced, and so on. So now as per new section 45 subsection 4, receipt of money or capital asset by a partner from firm on reconstitution of the firm, then capital gain shall be taxable in the hands of the specified entity, that is partnership firm. Interestingly, when a partner is receiving money or capital asset from the partnership firm, then the tax is to be paid by the partnership firm and not the recipient of the asset. Firm is giving the money or capital asset to the partners, and partnership firm will be paying the tax. How capital gain will be calculated? The money plus fair market value of the capital asset minus capital balance of the partner on the date of retirement, on the date of reconstitution. Earlier 45.4 was applicable specifically to the dissolution or the otherwise. Now dissolution is removed from the section. Now the section is applicable to the reconstitution, and reconstitution is separate from dissolution. This is also clear from section 9 capital B that we will discuss later on. So the moral is that if there is a reconstitution of the firm and there is a receipt of money or capital asset by partners from the firm, then the capital gain on this transaction shall be payable by the partnership firm, which will be calculated as money plus fair market value of the capital asset received less capital balance of the partner on the date of retirement, without considering the increase in capital due to revaluation of assets or self-generated goodwill. The dissolution is not covered under this section. So what loophole they have tried to plug by this amendment? What was happening earlier when on retirement or reconstitution of the firm, the partners in their individual capacity were getting some lump sum consideration. Say my capital balance was say rupees 50 lakhs on the date of retirement, and firm has paid me lump sum 1 crore to settle my dues on retirement. So there were judgments, Supreme Court in Mohan Bhai, Pama Bhai, Bombay High Court in Riyaz Sheikh, Karnataka High Court in Dynamic Enterprises. The law was settled that lump sum consideration received by the partner on retirement is not taxable irrespective of his capital balance on the date of retirement. So if my capital balance of 50 lakhs and I am getting lump sum 1 crore by check, then the excess 50 lakhs was not taxable pre-amendment, and that 50 lakhs that I was receiving was a kind of a goodwill of the firm. Or sometimes some tax planning was that firms were used to revalue their assets and increase the capital balance of the partners by crediting the goodwill to the credit of the capital account, and then they were used to pay lump sum payment to the partners equal to the capital balance, which was inclusive of revaluation of assets of self-generated goodwill. Now that is not to be considered, and in short, moral of the story is that whatever partner is receiving in excess of his capital balance before revaluation or before credit of self-generated goodwill is now taxable, but in the hands of firm and not in the hands of partner. Further, they have introduced section 9B. Earlier, as I said, section 45(4) was covering only the transfer of capital asset and not the stock in trade. So if the firm is transferring stock in trade to the partners on retirement, it was out of the purview of this scheme, a pre-amendment. Now, section 9B says transfer of capital asset or stock in trade by a firm to the partners in connection with reconstitution or dissolution of the firm. Now here, reconstitution and dissolution, both the instances are covered. Then it is taxable again in the hands of the firm under their capital gain or profits on gains or business provision, as the case may be. Here, full value of consideration on this deemed transfer is equal to fair market value of the capital asset or stock in trade. So if the firm is transferring capital asset or stock in trade to the partners on reconstitution or dissolution, then the resulting capital gain or PGBP shall be taxable in the hands of the firm, again, not the partners. Here there is a double taxation of capital asset because in 45(4) there is capital gain on transfer of capital asset is being taxed in the hands of the firm, and again in 9B because of deemed transfer, again there is a double taxation in the hands of the firm, and to mitigate this 48 subsection Roman 3 is introduced, that is deduction from capital gain in addition to the cost of acquisition and expenses on transfer. Relief to avoid double taxation of income in the hands of the firm on account of transfer of capital asset by firm to partners under section 45(4) or section 9B. This is because of, let me repeat, first section 45(4), taxation of amount or capital asset received by a partner in excess of capital balance in the hands of the firm. Whatever the partner is receiving in the form of money or capital asset in excess of his capital balance is being taxed in the hands of the firm under 45(4). Again, section 9B says taxation of transfer of capital asset, deemed transfer of capital asset by firm to the partner, again in the hands of the firm. So to the extent of transfer of capital asset by firm to partner, there is a double taxation. And to mitigate this, there is a relief by section 48 subsection 3. The doubly taxed part is to be deducted while calculating the capital gain under section 45(1) reduced section 48. So this is the whole scheme of new taxation in case of reconstitution of firm. The catch points are 45(4) is not applicable to the dissolution, whereas section 9B is applicable to the dissolution as well as reconstitution. Section 45(4) talks about receipt of money or capital asset. Section 9B talks about capital asset or stock in trade. Now, there is one interesting situation came to my mind after reading all this. Suppose there is a firm of two partners, Mr. A and Mr. B, and one of the partner has died, and by force of law that it is a dissolution because out of two partners, one partner died. Or another situation, one partner is retiring out of the two partners. Now again, it is a case of dissolution, and therefore, since it is a dissolution, 45(4) shall not be applicable. And in that case, if one of the partners is now continuing the business as it is and paying lump sum consideration to the retiring partner, including goodwill, then still the old law will prevail, and the lump sum consideration received by one of the retiring partners shall not be taxable even if it is in excess of his capital balance, because 45(4) is not, dissolution is not covered under 45(4), and when one of the two partners is retiring, it is a case of dissolution. So many such situations can come over a period of time, and that then we have to decide whether the old law shall prevail to that particular planning of retirement of partners or new law shall prevail. Now in this entire scheme, the word reconstitution is defined, whereas the word dissolution is not defined. But since section 9 is specifically talking about reconstitution or dissolution, and section 45(4) is talking only about reconstitution, it makes it clear beyond doubt that both are the different concepts, and accordingly 45(4) is not applicable to the dissolution. Now, taxation of ULIPs, section 10(10)(d), all types of unit linked insurance plans, section 10(10)(d) provide exemption in respect of sum received under life insurance policy if the premium is, section 10(10)(d) provides exemption in respect of sum received under a life insurance policy if premium payable for any of the years during the term of the policy does not exceed 10% of the sum insured. Considering the instances that high net worth individuals are claiming exemption under the said section by investing in ULIPs with huge premium, now Finance Bill 21 has proposed that the exemption under section 10(10)(d) shall not be available with respect of any ULIP issued on or after 1st February 2021 if the amount of premium payable during the term of the policy exceeds rupees 2,50,000 per annum. So high premium policies have now become taxable. Maturity proceeds shall be taxable if these conditions are satisfied. That is, the ULIPs are issued after 1st Feb 2021 and the premium payable during the term of the policy exceeds 2,50,000 per annum. And in that case, those maturity proceeds of such kind of ULIPs shall be taxable. Further, it has also been proposed that a ULIP which is not eligible for exemption under 10(10)(d), as discussed earlier, shall be treated as capital asset. What was happening earlier, all these insurance companies used to deduct TDS on the entire maturity proceeds, and there was a dispute that since all these companies are deducting tax at source on the gross maturity proceeds, whether the gross receipts are taxable or only profit element is taxable, because people used to invest certain amount by way of ULIP, SIP, or say one-time premium policy. And suppose I invested a one-time premium, say 5 lakh 10 years back, and now I am getting the maturity proceeds, say rupees 10 lakhs. So whether 10 lakhs is taxable or 5 lakh is taxable, because companies were used to deduct TDS on entire 10 lakhs. So they have clarified this, that it shall be treated as a capital asset, and accordingly the cost of acquisition shall be obviously allowable as a deduction. In the benefit of indexation shall also be available, and accordingly consequential amendments have also been made in TDS regime, wherein the insurance companies are now instructed to deduct TDS only on the profit element and not the gross receipts. Revision in the safe harbor limit in respect of transfer of immovable property below stamp duty value. Safe harbor limit, or we can say tolerance band, which was no such concept was there in the act. Then the concept of 5% of tolerance band came into the statute 2 years back. Now they have increased that tolerance band to 10%. If the stamp duty value of the property does not exceed 110% of the actual consideration received, then section 50C or 43C, then deeming fiction of section 50C, 43CA or section 56(2)(10) shall not be applicable. That is the summary of this particular amendment. In other words, suppose stamp duty value of the property is say 1 crore 9 lakh, and I am actually selling the property for 1 crore. Since the stamp duty value is not exceeding 110% of actual consideration, then 50C shall not be applicable. Similar for the sale of stock in trade, and similarly applicable for purchase of property. below stamp duty value. Now, whether this tolerance band prescribed by Finance Act 21 or tolerance band of 5% prescribed by Finance Act 220 with prospective, specifically it was a prospective amendment, but the various tribunals have clarified that this is a retrospective amendment since it is clarificatory in nature, and accordingly it shall be applicable since inception. And the useful reference is Maria Fernandez versus ITO 2021 judgment, Mumbai Tribunal 123 taxman.com 252, which said that this particular amendment of tolerance band is retrospective in nature. Further, there is a revision in safe harbor limit to the extent of 20% under this COVID regime. And this 20% benefit is also 20% tolerance band is available in case of transfer of residential property only during the period from 12th November 20 to 30th June 21 by a first time allotment to any person, and subject to consideration received maximum of 2 crores. So 20% tolerance band shall be allowed, and if the difference is up to 20 case of first time allotment to any person. 43 CA. Section 54 GB is regarding benefit from capital gain in respect of investment in equity share of eligible startup. Finance Bill 21 has proposed to extend the said outer date of transfer of residential property to 31st March 22. So this particular benefit shall continue to be available up to 31st March 22. Now, amendments relating to the return of income. Reduction in time limit for filing belated or revised return. The time limit has now been curtailed by reduced to 3 months. Now the belated revised return can be filed on or before 31st December of the assessment year or before the completion of which is earlier. In short, for the purpose, if we ignore the current COVID period and extension given by the government from time to time because of this COVID situation, normally as per the amendment, for the purpose of AY 21-22, the return can be filed only up to 31st December 2021. The belated and revised. Means suppose you have filed the original return on say 30th December, you can revise it only on or before 31st December, and that's it. So earlier we were allowed to file return within 12 months. Means AY 21-22 return was allowed to be filed up to 31st March 22 along with say 5,000, 10,000, 1,000 fees, late fees. Now there is a outer limit of 31st December only. 12 months limit, time limit is reduced to 9 months. Now exemption from the filing of return by individual whose age is 75 years or above. Senior citizens having age above 75 years are now given exemption from filing the return of income, provided they have income under their pension and interest only, and the interest income is from the same bank in which he is receiving his pension. However, bank shall be required to deduct tax at the rates in force. Reduction in time limit for processing of ITR and issuance of notice. Time limit for processing of income tax return and sending or intimation to the assessee has been proposed to be reduced from 1 year to 9 months. There is a curtailment of 3 months for all procedural aspects. This is applicable for CPC. Adjustments to be made by CPC while processing ITR. Earlier, section 143(1) subclause 4 was there, which used to allow CPC to make adjustments regarding the expenses which are reported by the auditor as disallowable under Form 3CD, but not disallowed in computation of income. The words were disallowance of expenditure indicated in Form 3CD, but not reported in computation of income. In such situations, CPC was allowed to make the adjustments, and CPC was allowed to disallow that particular expenditure which is reported as disallowable in Form 3CD but not disallowed in computation. Now amendment is there, and the new words are disallowance of expenditure of or increase in income indicated. In addition to the item of expenditure reported as disallowable, if certain item of income is reported as taxable by the auditor in 3CD, say for example there is an adjustment of ICDS, upward adjustment of ICDS is upward adjustment in income or profit because of ICDS is reported by auditor, or certain item of income which is reported as taxable by the auditor in 3CD but not apparently added to the income in computation. Now CPC can also add that through by way of intimation under 143(1). So whatever disallowances or additional income are reported by the auditor in 3CD shall be matched with the computation by CPC, and if there is a mismatch, the disallowance, the item of expenditure shall be disallowed or item of income shall be added back while processing the return under section 143(1). Notice to file the return of income can be issued by prescribed authority. This is a procedural amendment because of this faceless system. Earlier 142(1) was a notice can be issued was only assessing officer. Now to harmonize this issue of notice with the national faceless system, they have amended it and clarified that the prescribed income tax authority now be empowered to issue 142(1) notice, so that the e-assessment, any SC shall be eligible to issue such kind of notices. Assessments and appeals. Now, there is a big change in this reassessment system. The system of issue of notice under 148 and income escaping assessment under section 147 was fairly settled since last so many years. Now they have completely changed this particular reassessment system and also abolished section 153A, 153C, that is search related assessment, and entire system is merged in this income escaping system. We were discussing on new reassessment regime. Now, as per new reassessment regime, department can go back to 3 years. Earlier it was 6 years or 16 years. Now it is 3 years or 10 years. Because of this new reassessment system, now AY 13-14 to AY 17-18, all these 5 years are time barring on 30th June 21. Now, because of yesterday's notification, 30th September. So, department can reopen the cases of AY 13-14 to AY 17-18 on or before 30th September 21. And for AY 18-19 onwards, the new system shall be applicable and department can reopen up to 3 years. For example, AY 18-19 shall be time barring on 31st March 22 and so on. If they want to reopen the case of AY 18-19 by way of issue of notice under 148, they can issue notice up to 31st March 22 and so on. Further, if income escaping is likely to exceed 50 lakhs, now department can go back 10 years. However, this 10-year back power is not available for assessment years up to 2021. So, suppose they want to reopen on the basis of new regime, the assessment for AY 15-16 on the basis of this income escaping is exceeding 50 lakh, they cannot do that because there is special immunities given in the section itself. This power is not available for assessment years up to AY 2021. Now, in this new system, search 153A and 153C assessments, the 153ABC, all these sections are abolished and the search and survey assessments are also covered under this income escaping regime. The important features of this new system is that reasons to believe is now done away with. There is no such wording in the new section. Information with the department is sufficient to reopen the cases. Audit objection of CAG is sufficient to issue the notice. This law was fairly settled that cases cannot be reopened merely on the basis of audit objections of CAG, and AO has to apply his mind independently on the basis of reasons to believe. Now, as per new system, if the information is available with the department through any sources, they can reopen. If there is an audit objection, final audit objection of CAG, then it is also sufficient to issue the notice. Further, section 133A survey, section 132 search, and section 153 connected person assessment all are merged in the income escaping assessment. The new important feature in this scheme is that as per section 148A, inquiry before assessment and order of the AO on the basis of his inquiry and representation of the assessee is a must before issue of notice. Means, if AO has some information and he is of the opinion that it is a fit case for reopening, he has to first give an opportunity to the assessee of hearing. Under section 148A, he has to make detailed inquiry, and on the basis of his inquiry and reply of the assessee, the AO has to pass an order under 148A, and then he can proceed for income escaping assessment under section 147. Now, this particular new process of inquiry and order before issue of notice is not applicable for the new issues unearthed during the 147 proceeding. Suppose 148 is issued and for a particular issue, and during the course of assessment, AO come to know some other issues which were not part of his reasons. He can also make addition on those issues, and for those new issues which are unearthed during the course of assessment proceedings, no such inquiry and order mechanism is required. So these are the basic features of this new reassessment regime, which is for 147, 148 and 148A of the Income Tax Act. This particular new reassessment regime is a topic in itself on which we can discuss for 2-3 hours. So I have tried to summarize in short what are the highlighting features of this new scheme. Faceless scheme of IT-80 appeal. They have introduced e-filing before IT-80, then virtual video conferencing of hearing before IT-80 and so on. Now this scheme is in pipeline. Faceless electronic filing of appeal before IT-80 and faceless hearings before the IT-80. Whenever the department will come up with the notification and the rules and procedures, then the things will be more clear. Then there is a constitution of dispute resolution committee for small and medium taxpayers. Since the settlement commission has now been done away with, abolished, new system will come into place, that is dispute resolution committee. However, the government has not yet specified the rules and procedures for this, and it is expected to come in coming year. TDS and TCS related amendments. Before I proceed, I just want to make one thing clear. The department has kept on increasing the time limit for themselves for issue of notices under section 148. See, if we keep the COVID aside, AY 1314 was time barring on 31st March 2020. Under normal situation, notices under section 148 for AY 1314 would have been issued only up to 31st March 20. Now because of COVID, वो बढ़ते 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 30 सितंबर हुआ, फिर 31 मार्च हुआ, फिर अप्रैल हुआ और फिर 30 जून हुआ. Now still the AY 1314 is alive, and because of yesterday's notification, now 30th June has again extended to 30th September. So AY 1314, 14, 15, 15, 16, 16, 17, 17, 18, all are still live up to 30th September. Now there is a read petition. Now, what has happened? There was an taxation and other laws relaxation and amendment of certain Provision Act 2020, in short TOLA. This TOLA 2020 gave the government powers to increase all these timelines depending upon the COVID situation. They have this TOLA Act 2020, which came in September 20, gave the power to the government to decide the end of COVID period. What shall be the date on which COVID period shall be considered as ended, and accordingly the dates shall be decided by the government for extension for various purposes. Now on the basis of this TOLA, they are continuously they have continuously kept on increasing these timelines for assesses also and for department also. Now in a read petition number 11,766 of 2021, Armada Private Limited versus DCIT, there is a challenge before the Bombay High Court on to the notices issued on or after 1st April 21 in respect of AY 1314 and 1314-15 and so on. What is the argument there before the Bombay High Court? This is a judgment dated 9th June 21. Prima facie Bombay High Court found the force in the grounds, and they have put the stay on the working of the notices till further hearing. What has happened? The TOLA allowed the government to extend due dates, but TOLA never allowed the government to choose between the acts. Now, since new reassessment regime has come into force with effect from 1st April 21, for the purpose of assessment years 13-14, for example, they are still applying the old reassessment regime. So they are choosing between the finance acts depending upon the assessment year. So the challenge before the High Court is that there is no power to the government to choose between the acts. If they want to issue notice under section 148 for AY 1314 after 1st April, from which the new Finance Act 21 has become effective, they have to follow the new reassessment procedure. And since the notices issued by the department from 1st April 21 are issued completely on the basis of old law and without following the new procedure given by the Finance Act 21, all these notices are illegal and invalid. So let's see what happens in coming times. This is a important amendment in this area, which I thought to share with all of you. Now, coming to the TDS or TCS related amendments. This is much talk about amendment section 2061H, section 194Q, section 206AB, 206CC, and so on. Basic idea is that earlier, by way of section 2061H, TCS came into force with effect from 1st October 2020. if the turnover of the seller for the earlier financial year is about 10 crores and he is selling goods or services for more than 50 lakhs to a particular entity, then he has become liable to apply TCS at the rate of 0.1% on the sale proceeds about 50 lakh rupees. Similar provision has now become applicable for buyer also under section 194Q. So on the same transaction of sale purchase of goods above rupees 50 lakhs, TDS and TCS both are applicable. So they have clarified in the section itself that primary responsibility shall be of the buyer. So if a particular entity is a seller, X is a seller, Y is a buyer, both having turnover of 10 crores or more in earlier financial year, then primary responsibility shall be of the buyer to apply TDS while making payment to the seller. And in that case, seller shall not be liable for making the TCS. Now suppose if seller, because of his old practice since October 20, make TCS, then still the buyer shall be liable for TDS. He cannot absolve from his duties by saying that since seller ने TCS ले लिया है तो मैं TDS क्यों काटूं. This is not the way. Since the primary responsibility is on the buyer and he is eligible for this particular section, since his turnover is above 10 crores for earlier year, he shall be liable to make TDS even if seller has done the TCS. If not done, section 40A1, a disallowance of 30% of purchases shall be applicable. He shall be treated as assessee in default, interest under section 2011A and so on. All these implications shall follow. And there are a lot many other issues in this particular regime. And I request the audience to go through the frequently asked questions on this particular subject matter published by JDTPA in the newsletter for April 21. I have summarized some important FAQs on the basis of day-to-day issues, practical issues on this particular TDS TCS regime in the JDTPA newsletter of April 21, which is available in the group, and you can refer to that for further discussions. Then there is amendment related to the non-filers. They shall be subject to TDS TCS higher rates. The finance bill proposed to insert section 206AB and section 206CCA to provide for TDS or TCS at higher rates in case of non-filers of returns. The rate of TDS TCS shall be at the double of the specified rate or 5%, whichever is higher. Of course, these provisions shall not be applicable where the tax is required to be deducted under 192A, 194B, BB, LBC, 194N and so on. So while making TDS or TCS, if the deductee or collectee is a non-filer, having not filed the return of income for earlier 2 years and having TDS for those years above 50,000, then the payer shall be responsible to apply TDS at the double, at the rate which is double than the rate in force or the rate prescribed under the Act. For example, in case of section 194Q, suppose buyer is making payment to the seller and that seller is non-filer for last 2 years and so on, then TDS shall be at the rate of 5% instead of 0.1%. Now, how to check whether the deductee or collectee is a non-filer or not, and this is now the utility has come into force that bulk checking of filing status of the returns of the assessees is available online. Through that, the deductor or collector can check the applicability of section 206AB or CCA and decide accordingly. Charitable and religious trust related amendments. Law was fairly settled by Honorable Supreme Court 2 years back and many other judgments of High Court since last 10 years, during last 10 years, that if there is a loss in the net loss to the income expenditure account of the charitable trust, that loss can be carried forward to the next year, and in the next year it can be utilized as application of income. Excess application of income of earlier year can be utilized for the purpose of 85% threshold of the next year. Now, to overrule this, new amendment is there. It has been proposed that charitable trust shall not be permitted to claim any carry forward of losses. Therefore, no set off deduction allowance of any excess application of any preceding year shall be allowed while computing income required to be applied or accumulated during the previous year by such institution. Of course, this particular facility was also not available in the ITR schema. CBDT never gave this facility to carry forward the losses of the trust to the next year, and their intention was clear since inception that this should not be allowed. and accordingly they have made the amendment. So now excess application of income of earlier year cannot be utilized as application of income for current year. Or in other words, set off and carry forward of loss is not allowable in case of charitable trust. Now next amendment is amount applied out of loans not to be considered as application of income. This amendment is to avoid the benefit of double deduction. It has been proposed that utilization of borrowed money shall not be considered as an application of income for charitable or religious purposes. However, when loan or borrowing is repaid from the income of the previous year, such repayment shall be allowed as an application in the previous year in which it paid. So earlier what trusts were doing, both kind of deductions were availed by the trust. The utilization of the borrowed money now shall not be considered as an application of income for religious or charitable purposes. But the repayment of these loans out of current year's income shall now be allowed as application of income. Corpus contributions to be exempt only if invested. Voluntary contributions made with a specific direction that it shall form part of the corpus shall now be eligible for exemption only if those corpus donations are invested or deposited in the mode specified under section 11 subsection 5 maintained specifically for such purpose. Further, the amount spent from such corpus shall not be considered as an application against the mandatory 85% application for non-corpus income. In other words, once you are claiming the corpus donation as exempt from tax, at the same time you cannot say that allow this utilization of this corpus fund as application of income. Both deductions shall not be allowed. So now corpus donations are exempt from tax, and utilization of the amount or amount spent from such corpus shall not be considered as an application of income against mandatory 85% application for non-corpus income, and you have to apply 85% out of your current year's revenue receipts, which are separate from corpus donations. Exemption to educational or medical institutions having annual receipts up to 5 crores. As per section 1023C3AD or section 3AE, the educational or medical institutions which are working exclusively for the purpose of education and without any profit motive and having their turnover up to 1 crore per institution were outright exempt from tax without any necessity of taking any formal approval or registration. There was a controversy going on whether this threshold 1 crore is applicable to the entity as a whole or multiple institution wise which are working under the one parent body. Suppose one particular institution, parent trust having 4 different institutions. One is primary college, one is primary school, another is higher secondary school, another institution is science college, and so on. So earlier there were a lot of judgments which were in favor of the trust that this 1 crore threshold is applicable to institution wise, and the clubbing should not be done of the turnover of all the institutions while checking the applicability of this section. Now they have amended the section twofold. First, the limit of 1 crore is increased to 5 crores, and second, the turnover is to be clubbed for the entity as a whole, and then applicability of this section shall be checked. Now, suppose if 5 institutions are running under one roof under the parent body, and turnover of all those 5 institutions is above 5 crores, then this section shall not be applicable. In that case, that institution will have to apply for specific registration, say under section 12A or section 1023C Roman 6, depending upon the constitution of the trust. Miscellaneous amendments. We all know that Finance Act 2020 made the dividend taxable. Till Finance Act 2020, pre-amendment, dividend was outright exempt in the hands of the assessees, and companies were liable to pay dividend distribution tax. Now Finance Act 2020 abolished the DDT, dividend distribution tax, and made the dividend taxable in the hands of the recipients. And consequently the assessees in receipt of dividend had become liable to pay advance tax in respect of their dividend income. Now there is a relief if the shortfall in the advance tax installment or the failure to pay the same on time is on account of dividend income. It has been proposed that no interest under section 234C shall be charged, provided the assessee has paid full tax in subsequent advance tax installments. This is because of COVID-19. Then, in short, because of dividend income becoming taxable by Finance Act 2020, if initial advance tax installments have not been paid, no 234C interest shall be there, provided last installment should cover all the shortfall. Provisional attachment of assets in fake invoice cases. We all know that Section 271 AAD was introduced by Finance Act 2020, which was applicable to the false entry in books of accounts, bogus expenses claim, fake invoices, and the penalty was under Section 271 AAD. And to make this particular provision more stringent and powerful, Section 281B has now been amended. Assessing officer is empowered to provisionally attach the property of assessee during the pendency of proceeding under Section 271 AAD, that is penalty for fake invoices, if the amount or aggregate of the amount of penalty imposed is likely to exceed 2 crores. So during the course of penalty proceeding under Section 271 AAD, AO is of the opinion that in order to protect the interest of the revenue, it is necessary to do so. He can attach the property of the assessee even before finalization of the penalty proceedings, subject to the condition that amount of penalty which is likely to be imposed is 2 crores or. Before I proceed, let me recall in short Section 271 AAD. Section 271 AAD was a provision for the levy of penalty in case during the proceeding under the Act, if the AO found that in the books of accounts maintained by any person there is a false entry or there is a omission of any entry which is relevant for computation of total income of such person to evade the tax liability, then AO was empowered to direct that such person shall pay by of penalty sum equal to the aggregate amount of such false or omitted entry. False entry has been defined in the explanation. False entry include forged or falsified documents such as false invoices, false piece of documentary evidence, invoice in respect of supply or receipt of goods or services or both issued by the person or any other person without actual supply of receipt of such goods, that is hawala kind of transactions, or bogus bills without actual purchase of physical movement of goods, invoices in respect of supply or receipt of goods or services or both from a person who does not exist. In short, bogus expenses, fake invoices, false entry in the books of accounts, all these kind of situations are to be dealt with by the AO under Section 271 AAD for levy of penalty, in addition to the tax implications, if any. If there is a bogus purchase, obviously it will be disallowed while making the assessment. उसपे जो tax interest penalty under Section 270A or tax under Section 115BB at higher rate of 80-85%, वो जो tax penalty interest आने वाला है वो आएगा. In addition to that, AO is empowered to levy penalty equal to the amount of that particular false entry or fake invoice is liable to pay. Is empowered to levy the penalty equal to that amount under Section 271 AAD. Sometimes this burden can go even up to 200% of that particular transaction. So this is very serious and has now already become applicable from 1st April 2020. And during the course of audit for AY 21-22, we auditors should be aware of this provision and should check the accounts by keeping this particular provision in mind, because it is having very serious implications in future. One important amendment is definition of liable to tax. This is very important. Finance Act 2020, what Finance Act 2020 has done, Finance Act 2020 introduced concept of deemed residency under Section 6 subsection 1A. Rule for deciding whether a person is resident or non-resident was fairly settled under Section 6 subsection 1, residential status of an individual. Now, for the first time, deemed residency concept was introduced by Finance Act 2020, according to which a individual shall be deemed to be resident in India if such individual is not liable to tax in any other country or territory on account of his residence or domicile in that country, and his total income other than income from foreign sources, that is his Indian income, exceeds 15 lakh in a relevant financial year. In short, if someone is say non-resident living say in Dubai since years, however he is having some Indian income, say 15 lakh or more, say maybe in the form of return on investment, return on fixed deposits, interest income, income from house property in India, और ये इनकम उसका 15 लाख से ज्यादा है, इंडियन सोर्स इनकम, एंड ही इज अ नॉन रेसिडेंट इन इंडिया. सो आज तक क्या था, सिर्फ इंडियन इनकम वाज टैक्सेबल, ओनली इंडियन इनकम वाज टैक्सेबल इन केस ऑफ सच काइंड ऑफ नॉन रेसिडेंट और नॉट ऑर्डिनरी रेसिडेंट assessees. Now because of this deemed residency concept, if someone is having Indian income above 15 lakhs and he is not liable to tax in his parent country wherever he is living because of certain exemptions available there, he shall be deemed to be resident in India and accordingly his global income has become taxable. Now there is a controversy ki what is meant by liable to tax in any other country. Till date the law was settled, liable to tax is separate from payment of tax. As in case of a cooperative credit societies, societies are liable to tax, but because of deduction under section 80p they get 100% deduction of their income and ultimately they end up paying zero tax. Means they are not paying the tax but they are liable to tax. So this was the settled interpretation. Now to overcome this was the interpretation by Union of India versus Azadi Bachao Andolan, Supreme Court judgment of 2003, which said that liable to tax cannot be equated with payment of tax for the reason that liable to tax is a legal situation and payment of tax is a fiscal fact. Now government has clarified this by Finance Act 21 and they have introduced the definition of the word liable to tax in section 2 subsection 29A, according to which liable to tax in relation to a person means that there is a liability of such person under any law for the time being in force in any country and shall include a case where subsequent to the imposition of tax liability an exemption has been provided. That means if someone is liable to tax but not paying actual taxes because of certain exemptions available to him in that particular country, he still be treated as liable to tax he still be treated as not liable to tax in that country and accordingly shall come under the bracket of deemed residency. So this is the gamut of combined reading of amendment by Finance Act 2020 and 2021. I'll let me repeat the summary of both these amendments. To summarize, post amendment by Finance Act 21, an individual shall be deemed to be resident in India under section 61A if he is not paying any tax in any other country or territory owing to any exemption available to him under any law for the time being in force in that country, and he is having Indian income of 15 lakh rupees or more. In that case, he shall be deemed to be the resident of India and his global income shall become taxable in India, even if his foreign sourced income was not taxable in that foreign country. So these are the serious implications of this amendment. So this was the summary of the amendment by Finance Act 21. To the extent possible, I also tried to correlate the amendments by Finance Act 21 with the amendment by Finance Act 2020. There are a lot more other amendments also, which I thought I could discuss. The amendment by Finance Act 2020, especially that new personal tax regime. 2 different tax regimes are prescribed, but because of time constraint, let me finish here. And now I request host to continue the question answer session if time is available.
कावड्या सर, 148 जे तुम्ही म्हणताय मागचे 30 जूनचं 30 सप्टेंबर ते नाही झालेलं, 30 जूनच आहे माझ्यामध्ये, बघा जरा कन्फर्म.
हा सॉरी, ते नाही झालेलं, मी चुकलो बोलताना, मला लक्षात आलं ते नंतर. ते सोडून बाकी तारखा वाढवल्या त्यांनी.
एपीएमसी मध्ये शेतकरी करून दलालच्या थ्रू माल, कमिशन एजंटच्या थ्रू माल खरेदी करतात. 194Q ऍप्लिकेबल आहे
सर. 190 जसं 194N च्या वेळी त्यांनी स्पेसिफिक एक्झाम्पशन दिले दलाल आणि एपीएमसी त्या लोकांना कॅश विड्रॉल संबंधी. तसं काही सेपरेट एक्झाम्पशन 194Q मध्ये त्यांनी दिलेलं नाही अजून. जर ते क्यूच्या डेफिनेशन मध्ये बसेल तर ते ऍप्लिकेबल आहे, मग ते एपीएमसी असो, शेतकरी असो, काही असो.
ओके.
हा शिरोडे बोलतो.
हा बोला.
हा नमस्कार सर, बोला.
हे सेक्शन 6 ची जी अमेंडमेंट आहे, 15 लाखाचं इन्कम जे आहे ते इंडियात असलं पाहिजे ना.
इंडियन अदर दॅन फॉरेन सोर्स्ड इन्कम.
हा, इट मीन्स इन्कम शुड बी इंडिया.
आता सर त्यात फॉरेन सोर्स्ड इन्कम म्हणजे काय हे कुठे डिफाईन केलेलं नाहीये. आपण प्रायमरी असं समजू की इंडियन इन्कम
म्हणजे इंडियन इन्कम शुड बी ऍटलीस्ट 15 lakhs रुपीज.
हा, इंडियन इन्कम 15 लाख किंवा त्यापेक्षा जास्त पाहिजे आणि ही शुड बी लायबल टू ही शुड नॉट बी लायबल टू टॅक्स इन एनी अदर कंट्री. इन दॅट केस ही शॅल बी डीम्ड टू बी द रेसिडेंट ऑफ इंडिया.
जर एखादी फर्म डिझॉल्व होत असेल, ऍसेट जे असतील डेप्रिशिएबल ऍसेट त्या बाबतीत मग काय ट्रीटमेंट होईल?
सर
Depreciable asset.
सेक्शन 9B प्रमाणे तुम्हाला जावं लागेल की सेक्शन 9B इज ऍप्लिकेबल टू द डिझोल्युशन.
कारण डिप्रिसिएबल म्हणजे बिल्डिंग जी असते
हा
ती डिप्रिसिएबल असते आणि जागा जी असते
सर सेक्शन 9B इज ऍप्लिकेबल टू द ट्रान्सफर ऑफ कॅपिटल ऍसेट अँड स्टॉक इन ट्रेड. Transfer of capital asset stock in trade by the firm to the partners in connection with reconstitution of dissolution of firm. आता depreciable asset जरी असली तरी ती कॅपिटल ऍसेट आहे बेसिकली.
नाही, मागच्या रविवारी सिनियर झाला होता,
हा
त्यांनी म्हटलं होतं की बा जरी ऍसेट डिप्रिसिएबल असेल तरी तिची कॉस्ट पकडली जाईल.
हो ना, त्याला ऍप्लिकेबल आहे बेसिकली सेक्शन. आणि टॅक्सेबल इन द हँड्स ऑफ द फर्म अंडर द हेड कॅपिटल गेन और पीजीपीपी ऍज द केस मे बी.
आणि समजा ती फर्मने ते म्हणजे डिझॉल्व्ह करताना पहिले ऍसेट विकून टाकली,
मग तो प्रश्नच राहत नाही सर. बघा, जेव्हा तुम्ही कॅपिटल ऍसेट किंवा स्टॉक इन ट्रेड पार्टनरांना देताय तेव्हाच तो सेक्शन ऍप्लिकेबल आहे.
नाही, बाहेर विकले आपण तर
म्हणजे तुम्ही इन शॉर्ट तुम्ही ऍसेट्स लिक्विडेट केल्या.
हा, राईट राईट.
मग ते नॉर्मल प्रोव्हिजन आहे ना, सेक्शन 50 शॉर्ट टर्म कॅपिटल गेन डीम्ड एसटीसीजी.
अच्छा.
पण पार्टनरचं कॅपिटल अकाउंट 50 लाख आहे समजा आणि आपण 75 लाख देते, 25 लाखाची लायबिलिटी याच्यावर येईल ना.
पूर्वी कसं होतं सर की हे आउटरेट एक्झम्प्ट होतं सगळं. पार्टनरला कॅपिटल बॅलन्स 1 रुपया, त्याला 10 रुपये जरी मिळाले आणि तुम्ही थोडंसं स्मार्टली जर पार्टनरशिप रिटायरमेंट डीड ड्राफ्ट केलं तर हे आउटरेट एक्झम्प्ट होत होतं सगळं. पण आता तो लूप होल त्यांनी काढला. कॅपिटल बॅलन्सच्या पेक्षा जास्त जे काय मिळेल ते इन द टॅक्सेबल इन द हँड्स ऑफ द फर्म.
पण मग ते कॅश मध्ये जर असेल किंवा म्हणजे पेमेंट असेल समजा, तर मग कॅपिटल गेन मध्ये नाही येणार ना.
नाही, सेक्शन 45(4) नुसार ते पार्टनरशिप फर्मच्या हातात टॅक्सेबल येईल. याच्यात सर 2 गोष्टी लक्षात ठेवायच्या आहे. पार्टनर 45(4) इज ऍप्लिकेबल टू मनी और कॅपिटल ऍसेट ऑन रिकॉन्स्टिट्यूशन आणि 9B इज ऍप्लिकेबल टू कॅपिटल ऍसेट अँड स्टॉक इन ट्रेड ऑन रिकॉन्स्टिट्यूशन अँड डिझोल्युशन. हे परम्युटेशन कॉम्बिनेशन बघावे लागतील तुम्हाला. तुम्ही काय
डिझोल्युशनला 45(4) फक्त याला डिझोल्युशनला नाहीये
आणि 45(4) स्टॉक इन ट्रेडला नाहीये, 9B स्टॉक इन ट्रेडला आहे. आणि मनी जर असेल ती मनी 45(4) मध्ये कवर्ड आहे, 9B मध्ये मनी कवर्ड नाहीये, फक्त कॅपिटल ऍसेट आणि स्टॉक इन ट्रेड कवर्ड आहे. थोडक्यात काय, हे कुठे ना कुठे तुम्ही पकडले जाणार या नव्या स्कीम मध्ये.
ओके ओके.
मला जे एक लूप होल सापडला ऍपरंटली तो मी डिस्कस केला की 2च जर पार्टनर असतील आणि एक जर बाहेर जात असेल किंवा मेला तो, किंवा एक जर रिटायर होत असेल आणि दुसरा जर तो बिझनेस कंटिन्यू करत असेल ऍज अ प्रोपरायटर आणि जो रिटायर होतोय त्याला जर लमसम पैसे मिळत असतील ओव्हर अँड अबोव्ह कॅपिटल बॅलन्स, तर त्याला तो बाहेर नाही गेल्या नव्या स्कीम मधनं, तो जुन्या स्कीम प्रमाणेच तिथे टॅक्स लागणार नाही. कारण ती इट शॅल बी ट्रीटेड एज अ डिझोल्युशन ऑफ द फर्म आणि 45(4) ला डिझोल्युशनला लागत नाही आणि त्याला लमसम जे मिळते तो मनी मिळते, त्याच्यामध्ये 9B लागणार नाही. कारण 9B मध्ये मनी कव्हर होत नाही आणि 45(4) मध्ये डिझोल्युशन कव्हर होत नाही.
ओके, म्हणजे तुमचं म्हणणं असं 2 पार्टनर असेल, एखाद्याचा डेट चालत त्या डेटच्या आधी त्याच्या कॅपिटलपेक्षा त्याला जास्त पैसे गेले तरी टॅक्स
कुठेच येत नाही, जुन्या नियमाप्रमाणेच. असं माझं प्रायमा फेसी मत आहे. शिरोडे सर आपल्याला गाईड करतील.
हॅलो.
हा सर.
As per Supreme Court decision, when there are only 2 partners, by operation of law, that firm can dissolve.
Yes.
That's why once you are dissolved, and once that does not happen to section 45(4),
yes,
then that this should be exempted.
Yes, correct sir. सर एक मला याच्यात शंका आहे की यांनी काय केलं सर, जेव्हा फायनान्स बिल आणला तेव्हा 45(4) मध्ये डिझोल्युशन शब्द होता.
हो.
आणि फायनान्स ऍक्ट जेव्हा आला तेव्हा त्यांना डिझोल्युशन वर्ड काढून टाकला. त्याचं कारण काही समजलं नाही मला. फायनान्स बिल 21 मध्ये 45(4)च्या ड्राफ्ट मध्ये डिझोल्युशन आणि रिकॉन्स्टिट्यूशन दोन्ही शब्द होते, जसे 9B मध्ये आहेत तसे. पण फायनान्स ऍक्ट मध्ये येता येता तो डिझोल्युशन वर्ड शब्द निघून गेला 45(4) मधनं.
I think it was discussed during while passing the bill.
नाही सर,
हा
एक क्वेरी अशी चॅट बॉक्स मध्ये वाचतो, इज देअर इज नो डिझोल्युशन ऑर रिकॉन्स्टिट्यूशन ऑफ फर्म बट पार्टनर वांट टू टेक स्टॉक इन ट्रेड टू होम, व्हाट
टॅक्सेबल
ॲज पर 9B.
नाही सर, 9B किंवा 45(4) नाही, त्याला नॉर्मल प्रोव्हिजन लागेल ना. 9B तर रिकॉन्स्टिट्यूशन किंवा समजा पार्टनर एखादा पार्टनर व्हाईल कंटिन्युइंग विथ द फर्म ऍज अ पार्टनर जर काही ऍसेट घेतोय फर्म मधनं, कॅपिटल ऍसेट घेतोय किंवा स्टॉक घेतोय तर त्याला नॉर्मल प्रोव्हिजन लागेल.
त्याच्यामध्ये ज्यावेळेस पार्टनर ते एखादी असेट किंवा गुड्स टेक अवे करतो, then such a case do say that it is withdrawal. It is not transfer.
अच्छा, कॅपिटल अकाउंटला डेबिट पडेल त्याच्या विड्रॉल फ्रॉम
कॅपिटल अकाउंटला डेबिट पडेल. इट इज नॉट ट्रान्सफर.
सर तुमचं म्हणणं असं आहे की डिझोल्युशन पण नाही, रिकॉन्स्टिट्यूशन पण नाही, त्यामुळे ते डेबिट पडेल, त्या टॅक्सिबिलिटी कुठे येणार आहे असं म्हणताय ना?
नाही.
सर पण त्याला पुन्हा मग 50C वगैरे समजा तो एखादी कॅपिटल ऍसेट नेतोय बुक व्हॅल्यूला.
नाही, फर्स्ट ऑफ ऑल दॅट असेट शुड बी देयर शुड बी ट्रान्सफर.
हो ना सर. सर एखादी इमूवेबल प्रॉपर्टी जर पार्टनर नेतोय फर्म बंद व्हाईल कंटिन्युइंग ऍज अ पार्टनर विथ द फर्म, तर त्याची जी बुक व्हॅल्यू आहे तिथे त्याच्या कॅपिटल अकाउंटला डेबिट पडेल.
करेक्ट.
आणि पण ती इमूवेबल असल्यामुळे रेकॉर्ड ऑफ राईट्स मध्ये त्याचं नाव लागेल, ओनरशिप बदलेल.
बेसिक गोष्ट कशी आहे, वेदर देर इज ट्रान्सफर ऑर नॉट.
ऑफकोर्स इमूवेबल प्रॉपर्टी त्याच्या इंडिव्हिज्युअल कॅपॅसिटी मध्ये त्याला घ्यायची तर ट्रान्सफर तर होईलच ना सर. रजिस्टर्ड डीड होईल, सब रजिस्टर समोर.
Old Supreme Court judgment, which says that whenever any asset or any goods are withdrawn by the partner, in such a case does not amount to transfer.
सर पण आय थिंक त्याला मग समजा इमूवेबल प्रॉपर्टी बुक्स मध्ये 5 लाखाची आहे, त्याचं स्टॅम्प ड्युटी व्हॅल्यू 25 लाख आहे, तर त्याला मग पुन्हा 56/10
ची ऍप्लिकेबिलिटी पाहावी लागेल.
ते ऍप्लिकेबल होऊ शकेल त्याला.
We can apply the same analogy. Firms and partners are not different.
अच्छा.
That's why 56/10 will not get.
ओके.
थोडक्यात सर डिझोल्युशन रिकॉन्स्टिट्यूशन असेल तरच टॅक्सिबिलिटी फॉर्मला येईल.
Yes sir.
एनी अदर क्वेरी? मला असं वाटतं विनय सर आता काही कोणी क्वेरी नाहीये कोणती.
ओके सर. ओके.
मी मुकेश अग्रवाल सरांना विनंती करतो की त्यांनी आभार प्रदर्शन करावं.
धन्यवाद केअरटेकर प्रेसिडेंट साहेबराव पाटील आजच्या मीटिंगचे. खरं विनय सर म्हणजे 11th ओव्हरला त्यांनी सांगितलं की मी सबस्टिट्यूट करतोय, पण रिअल ही सबस्टिट्यूटेड. मूर्ती लहान दोघांची, आणि विनय सर तुमची कीर्ती पण तशीच महान राहाव ही देवचरणी प्रार्थना.
थँक्यू.
खूप सुंदर, एवढ्या सुंदर प्रकारे अमेंडमेंटचं विश्लेषण केलं की खूप वेळेस वाटत होतं की आज बहुतेक आम्ही दोषी सरांनाच ऐकतोय की काय. एकदम मुद्देसूद, एकदम सुंदर पद्धतीने मी मॅनेजमेंट कमिटीतर्फे JDTPA मॅनेजमेंट कमिटीतर्फे आपले आभार मानतो की आपण 11th ओव्हरला येऊन सुद्धा 2020 मॅच जिंकला. सुंदर, अतिसुंदर. आणि आयुष्यात अशाच प्रकारे आपलं मार्गदर्शन आमच्या JDTPA ला मिळत राहावं हीच अपेक्षा. सोबतच मंदार, त्याला टेक्निकली मी काय सांगू, हा नेहमी आम्हाला एवढं सपोर्ट करतो. 2 मिनिटात तुमच्याकडून PDF मध्ये सगळं घेऊन त्याने प्रेझेंट केलं. मंदार थँक्स अ लॉट भाई. तुम्ही नसलात मंदार सर, तुम्ही नसलात तर आम्हाला वाटतं आमचं व्हर्च्युअल बंद होऊन जाईल आणि फिजिकल घेता येणार नाही. काय हाल होतील आमच्या मला माहिती. आणि सरते शेवटी आज मर्गन पाटील सर नसताना, व्हाईस प्रेसिडेंट साहेबराव पाटील सर यांच्या हातात धुरा असताना त्यांनी मला या वोट ऑफ थँक्स साठी योग्य समजलं. साहेबराव पाटील सर आपलेही धन्यवाद, मॅनेजमेंट कमिटीचे धन्यवाद. आणि परत एकदा हा मंच, हा माईक मी आजचे अध्यक्ष साहेबराव पाटील सरांकडे सोपवतो. साहेबराव पाटील सर.
पाटील सर, साहेबराव पाटील सर.
बोला सर, बोला.
एक इनपुट आलाय मला की आता जो प्रश्न विचारलाय कोणी की बाबा ऍग्रिकल्चर APMC संबंधी 194Q चा, त्याच्याबद्दल एका मेंबरकडनं एक इनपुट आलंय की when purchases are made by APMC dealers from the farmers, whether section 194Q is applicable. आणि त्याच्यावर त्यांचं असं मत आहे की since the agriculture income is exempt under section 10, TDS need not be done under chapter 17B. Hence section 194Q also is not applicable.
पण सर शेतकऱ्याकडून आपण जर 50 लाखाच्या वरचा विषय आहे तो तर तिथं पण बसत नसेल जास्त करून.
नाही, समजा आपण इमॅजिन करू अशी सिच्युएशन की एखादा APMC चा डीलर आहे, तो शेतकऱ्याकडून समजा 1 कोटीचा माल घेतोय.
ओके.
आता याच्यात विषय असा आहे की शेतकऱ्याला तर ते 1 कोटी पूर्ण एक्झाम्प्ट आहे ऍग्रिकल्चर इन्कम असल्यामुळे, आणि त्यामुळे शेतकऱ्याला जर ते इन्कमच एक्झाम्प्ट आहे तर त्याला TDS लागू नये. त्याच्यामुळे सेक्शन 194Q सुद्धा त्याला अप्लाय होणार नाही असं प्रायमा फेशी कसं मत आहे. शिरोडे सर
तुम्ही आहेत?
हो आहे.
का तुमचं काय मध्ये सांगा.
अँबिग्युटी याच्यात आता जो कमिशन एजंट असतो APMC मध्ये थ्रू परचेस करणारा, whether it amounts to purchase or not.
अच्छा, तो आडते आहे एक प्रकारे.
He is a commission agent, no?
पण सर कमिशन एजंट जर असेल तर पक्का अर्थ असेल तर त्याला आपण 44 मिनिट टर्नओव्हर पकडतो त्याला आपण, त्याच्यामुळे तो व्यापारी झाला म्हणजे.
नाही, काय सर, कच्चा अर्थ आणि पक्का अर्थ, that distinction is to be made. If he is purchasing on behalf of the upcountry constituent, then he does not become the purchaser. Purchaser will be the party who has actually purchased the goods through that agent.
पाटील
That's
सर,
why that provision.
बोला सर, बोला.
आपण हा मुद्दा पेंडिंग ठेवू. मी लवकरच क्लॅरिफिकेशन देतो ग्रुपवर याचा.
ग्रुपवर तुम्ही सांगत
हो.
थँक्यू सर्वांचा आभारी आहे. आणि आजची स्टडी सर्कल मीटिंग संपल्यास मी जाहीर करतो. मंदारजी करा.
सर, ओके, करतो.
थँक्यू मुकेश, थँक्यू.
ओके, थँक्यू सर.
थँक्यू एव्हरीवन.
थँक्यू एव्हरीवन मेंबर.